A week ago today, the 10-year peaked at about 4.34% in the yield. Now it's under 4.23 at the moment. How important is that to the sectors that you're tracking?
It's extremely important for the sectors, but also the overall market. This week, we have $127 billion worth of notes, the 2, 5, and 7s. They should do well with these yields, but it's an awful lot for the Treasury market to digest. If they're having trouble with that, it could push the yields higher than we want. We'll see how the market reacts to that, because that's certainly been an issue for the market. It isn't just that the better economic data is pushing the yields up. It is the amount that the Treasury has to auction off to pay bills. What
does better mean this month when it comes to economic data, right? When we're looking ahead to PCE and this jobs number, is it, strong but not too strong? Is it a little weaker, a little better still?
Well, what you could be looking for really, I think, is the wages. It doesn't even matter, where the number comes in, 182,000 new jobs, 210,000 new jobs. If those wages continue to climb higher, it is not going to be seen as positive for the market. Because in addition to all of that, take a look at the deals that are out there in the market right now in terms of negotiating. United Auto Workers, the airline pilots, United Parcel Service, all getting higher wages. This is not something that the Fed wants to see at this point, because clearly they're going to want to raise prices across the board for the ultimate consumer, whether it's retail or whether it's business.
So which should investors pay more attention to, the number that we get on Friday where wages are concerned, or what we can see unfolding before us with the auto workers almost certain to go on strike, asking for some really big numbers, 40% raise, and perhaps more likely than ever to get them because UPS drivers did so well?
Exactly. And this is a side pressure on the market. The Treasury market is going to be picking up on this, that wages are going higher. We'll probably start to see prices climbing even more. We started to see prices paid components of the ISM manufacturing, the ISM service sector, starting to inch higher. But that is nothing compared with what could happen as the auto workers get higher wages. The car prices are high enough. The new car prices are high enough, coupled with loans that are just out of reach for most Americans. This is going to be, I think, dangerous for the overall economy. I don't want to sound like Paul Volcker, but keep in mind, the Fed and the doves and the hawks are watching this. This is not something they want to see.
So is that effectively, you think, a floor under yields then, and a potential ceiling on equities?
Well, yeah. I mean, if you start to see the yields climb above 4.4, climbing higher, it isn't the fact that we're moving into a higher range. We had 70 years of just about 5% on the 10-year. It is the quick move, the quick pace that we're seeing. We went cold turkey from zero negative rates to now rates that we haven't seen in many years. And what that means is that those that took out loans at a lower rate suddenly are facing higher rates so quickly. That's the issue. It is the speed at which this is happening. The calculus is changing. And as we go to that transition in calculus, it's going to cause pain for private equity firms, for commercial real estate, and individuals who've taken out variable loans on a number of products, including their homes.
Yeah, the winds are picking up out there economically for sure. Yeah. Quincy Krosby, thank you.
Thank you. Thank you.
For more investment ideas, be sure to tune in to a special back-to-school edition of Mad Money with Jim Cramer. That series starts tonight and continues all week long at 6 p.m. Eastern.